recently, some people that have got nervous should not be getting nervous in any way. You're in a parabola. When will this gold market be over? Now, it's been knocked back because it was doing far too much, far too quickly. It took 6 months to do what took 120 years to do, and later 12 years to do. So particularly with regards to silver, the next big move is 90. It's going to pause before running 100. So whatever it does do, let's say it comes a little bit back, that's next key interim level is at 90.9. My eyes, I need to check. 90.68, around $91. So we're going to pause just shy of 100, or we might just do a technical run of the 100 and get rejected and churn around here for a while. And then the next move is 333 for me.
In this deep dive, market strategist Francis Hunt uncovers a remarkable pattern in gold's long-term chart that dates back to the 1800s. The first $1,000 milestone in gold took nearly 120 years to achieve, but each $1,000 move since has arrived dramatically faster. From 2008 to 2020, it took 12 years to jump another 1,000, then just 5 years to reach $3,000, and now under 6 months to touch $4,000. That acceleration forms what analysts call a parabolic curve, where prices climb faster in shorter bursts of time. It's not just a reflection of gold's strength, but a signal that the financial world is changing rapidly. When fiat currencies weaken and trust fades, real assets respond with speed and power. As this momentum builds, understanding the curve could be key to navigating what's next. If you found this insight valuable, don't forget to like, share, and subscribe to the Bullion Boss, your source for gold, silver, and the truth behind the markets.
I've got a gold chart that goes back to 1883. The first $1,000 to make it took 120 years. It was 2008 that we got the first time we crossed $1,000. So that was 120 years. The time duration to the next $1,000 was 12 years. So you went from 2008 to 2020. I think you'd agree that's quite a reduced rate of time for the same movement in dollars. Then the next 1,000 from 2020 to the point where we ran 3,000 was 5 years. So it was 2020 was that high, and we did 3,000 this year, mid-year. Then the next 1,000 where we actually ran 4,000 was under 6 months. So you've gone 120, 12, 5, 0.5. Now, if anybody understands what a parabola is, when you non-log a chart, and I'll show this visually in a minute, but it is when for you're achieving a linear chart is 1 unit of time, 1 unit of climb. That's a 45-degree angle, and it's quite linear. And if you do another unit of time and you do another unit of climb, you end up with a 45-degree line. If you are doing 120 years to get 1,000, and then you are doing 12 to get your next 1,000, and 5, and then 0.5, what you're actually getting is ever reducing time frame, yet the climb rate is ever higher. That's the definition of a parabola. So what tends to happen is when you're getting more parabolic, there's a lot of people that are recognizing it's parabolic and just can't afford not to be in. So they just chase and hit the stack. All sense of pricing and value, it's just about get me gold, get me silver. What that happens, when that happens, typically you have an order stack and a bid stack. And normally it's proliferated with depth with levels that people are prepared to get in. When you get price advances that accelerate too fast, you get a bit of a thinning of the bid and order stack because it's moved too dynamically. And what that means is it starts to overshoot. And then eventually you get to a point where some people say, well, it's a bit much in such a short time frame, could have a pullback. The sellers start to sell, and the bid stack hasn't built up. So there's less volume. So they push it further down. It's just the introduction of volatility. What happens is people's need to get used to an entirely new level and standard for gold price and fiat debasement, because it's actually restricted by our paradigm of ability to understand where it should be when you talk about the metals markets, they actually went down during the financialization of everything years. The financialization of everything years was from the Volcker period where he spiked rates. He killed the gold bull at the time and resaved the debt markets and pushed rates so high. He made bonds so cheap that they actually became potentially quite valuable. And then we had the 40-year bond cycle. During that period, gold, there was still inflation. There was still an expansion in monetary supply. Gold should have been doing a linear increase according to the M2. And in fact, the M2 itself started to be more of a parabola, but gold actually went down from its 800s, well down until it hit a lows around 200s in 99, going 2000s. Just as we were having one of our first major bubbles, being the dot-com. And that was basically the bottom of gold. It started to move up, but everything else was still moving up faster. So what's actually happened is we're getting a parabola now for all the back pay we're owed for when gold should have been doing what the M2 was doing and actually was going in the opposite direction. So it was suppressed, it was ignored. Everyone goes, why do you want to hold that? It doesn't pay any interest. You dig a hole in the ground, you get it out, and you put it in some other hole in the ground. All the Warren Buffettisms, all the various things. It's the culture. It's the epoch of stocks. That is the S&P. There is the place where there was nothing else you should be in but the stock market. Right there. It was killing against everything. It was killing against gold ounces. This is the SPY divided by gold. To say this is a melt-up means that it is the predominant asset of choice for which everyone should be in and waiting to sell the top. Right now, this is quite clearly not a melt-up, not in dollar and gold ounces. In nominal devaluing dollars, it looks absolutely fantastic. But you've actually got quite possibly a head and shoulder formed. We had a little bit of a pullback on gold, which is part of your question, which I'll still answer. And you might get a bounce here now of the SPY relative to gold, but that is probably a reversal, a rounding top, and it's nowhere near what happened there. This isn't a melt-up. That is a melt-up by definition. So let's talk about the gold's price recently and why some people that have got nervous should not be getting nervous in any way. You're in a parabola. When will this gold market be over? Now, it's been knocked back because it was doing far too much, far too quickly. It took 6 months to do what took 120 years to do, and later 12 years to do.
Market analyst Francis Hunt takes a closer look at silver's price action and what could come next. He points out that silver is sitting in a crucial 45 to 50 range, a zone that often sets the stage for big, long-term moves. Many see the pattern as a classic cup and handle, but this time, the setup signals that silver might first take a breather before the next breakout. He explains that while investors wait for that face-ripping rally, this rest phase is healthy and necessary, giving the market time to build real strength. History shows that each pause in silver has paved the way for massive gains down the line. Let's watch more clips from the interview.
So particularly with regards to silver, you may recall when we spoke that on that silver, we said there's a 45 to 50 range that we think that there's going to be we go once, twice, 3 times a lady. And many people that draw the classic, what they call the cup and handle, you've had the once of the 1980, you've had the return. We'll go to silver and I think I'll answer, let me do that right away because that's your current question. So yes, we foresaw a pullback. We said you're not going to get your face-ripping move yet on silver, which tells us that gold, the whole complex, will likely have a rest. It's quite likely at this range. We put a box on it. We weren't able to give you an exact price point, but we said as you approach 50, 3 times, and then your lady. That's your winning. You walked off with the beautiful girl. That's it. It comes there. But 3 rejections. She says no to you 3 times. And on the 4th time, you're going out for that date together. And this is a bit of a shooting star here, and there is a pullback. How on the bigger time frames, it's going to be interesting to see where the month ends. It does point to an inter-rejection. You can see, for example, that was a violent one, a more violent one, and it did lead to further downside. This is actually, by log scale, not particularly violent, and we said the pullback will be less and not as deep. And this is the next big move. This is the primary move. This is your most exciting move coming. And it's you once you've hit 3 times, you have to wait for that dip to do it. So we did predict that. I mean, we also appeared with Mario, and he was saying, no, I think it just ripped straight from here. And we were saying, no, I think despite it looking super strong right now, that was while this was happening, and you were up at the 54s, we still think you get that rejection. And it came a little later, but there's a little bit of an inflationary tilt to this. This high is tiny bit higher than that one as well. You've got to remember there's a certain time period between each of these, and again, the fiat debasement. But so if we do our HVF method draw, which is something that we're unique, we'll recap the silver targets with you. So here's our setup. Now, HVF method is our unique trading methodology, and it got us long this trade well before the cup and handle guys were in here. For them, it was only interesting once we got to the $50 mark, or the $45, $50 mark. For us, you broke over here, and that was still in the 30s. And your stop loss is there, and this has made what we call our first interim target. And typically after running that line, you'll see it there at $40, 40.92. So once you've run 41, you typically get at some point some degree of pullback. Now, how far does the pullback go? Our worst case scenario would be a revisit to our green line there. It doesn't have to do that, but sometimes it can happen. It's called a return move to the triggering event here. That would bring you right down to the 30s. I don't feel that. This rejection is nothing like the scale of that shooting star rejection. So I think you get a little bit lower. The key is the bottom pick you need to do on our leverage trade, because we are turbo stacking ounces. So what happens next is some form of return move. Can't tell you it will go all the way to the green line. I think it's going to be a lot shallower. Sometimes it supports on our first interim target and does a dip there. And sometimes it turns even sooner. So we'll see about that. But the next big move is 90. It's going to pause before running 100. So whatever it does do, let's say it comes a little bit back, that's next key interim level is at 90.9. I need to check. 90.68, around $91. So we're going to pause just shy of 100, or we might just do a technical run of the 100 and get rejected and churn around here for a while. And then the next move is 333 for me. So these open areas between the targets are typically carried with immense, but it's not the same dollar, and there's going to be potentially some degree of crisis that could go along with this.
When you step back and see the bigger picture, both gold and silver are telling the same story. Momentum is building, even if it's not always visible day to day. Gold's rapid climb reveals an underlying shift in global confidence, while silver's consolidation hints at pressure building beneath the surface. These metals aren't just reacting to charts, they're responding to decades of economic imbalance and the loss of trust in paper wealth. This is the calm before the next surge, a period when patient investors prepare, not panic. The data, the patterns, and the sentiment all point toward one truth: the era of real assets is rising again. When the next move begins, those who stayed focused will be the ones rewarded. Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.